Recoveries don't announce themselves, they whisper through the data. Inflation's in check, the OCR's being cut, sales volumes are nudging up. If you're waiting for a headline to tell you the market's back, you'll miss it. Joining us again is Kelvin Davidson, Chief Property Economist at Cotality, to help you see what smart investors are already watching.
Financial freedom faster. Financial freedom faster.
If you like watching other people make money, keep scrolling. But if you're the kind of person who wants the edge, the insight before the headlines, hit subscribe. Because in 2025, more New Zealand investors get their housing intel from this show than anywhere else on YouTube. The smart ones already know. Now you do too. Kelvin, what signals in the June data point to a market that's quietly recovering?
Yeah, well, the first thing you tend to look at is of course sales activity, and so really what we're seeing for sales at the moment is a rising trend. Now, I think it's important with sales at the moment to look at growth and levels, because there are sort of differences in those two measures. And so if you look at the level of sales, they've only really just returned to normal now, and that's because they were starting from such a low base. So, but in terms of growth, there's been a lot of growth. So there's two very important distinctions to make there. So if you go back to 2022, 2023, the level of sales was basically at a 40-year low. Since then, we've had pretty steady growth, but because it started from such a low base, we're only just back to normal now. So it's really only been about the last maybe 2-3 months where it's got back to some kind of normality. So it's been a long, slow grind. I think now we're probably back to a situation where sales are roughly about normal, maybe even ticking slightly above. So that's the first thing. Activity measures tends to be what people would go to first. And as I say, we're roughly back to normal on that. So that's the first thing. I guess the other thing is that we're starting to see just that stock of listings that's on the market come down ever so slightly. And so, the sales are starting to eat into that stock or overhang of listings just a tiny little bit. And of course, they're starting from such a high level anyway, it's going to take some time. But I suppose those are the two things I'd point to in terms of activity. Sales rising, just starting to eat into those stock levels a little bit. In terms of values, yeah, it's still a bit patchy. I mean, for every month that we see values going up, we're seeing another month where they go back down again. So I think probably in terms of the housing cycle where we're at right now, you'd really have to be looking at the activity measures. We're starting to see signs that they're picking up. There's always a lag from activity to values. So it could be that, values start to react a little bit more strongly once we get into, the final few months of the year. But right now, those value measures are still looking a bit soft and a bit patchy. So yeah, I guess spring's going to be a really big test for the market. Always is. People are always interested in what's happening in spring. Where you see that rise in listings, the rise in activity, people, coming out from their winter hibernation again. So I guess as always, people will be looking ahead to spring. But yeah, right now it's activity measures that are starting to turn around a little bit. Value is still a bit patchy, but maybe a stronger upturn to come down the track.
And how is the OCR going to impact the second half of the year?
I think the OCR, probably in terms of the housing market, a lot of that impact, it's probably already done in some ways. The banks react in advance of the OCR anyway. So, any further sort of OCR cuts that are to come, which might not be many, we're probably getting a lot closer to that trough for the official cash rate. A lot of that's already been priced into current mortgage rates anyway. We're down at sub 5% for a lot of those fixed rates. So I think probably, in terms of the direct OCR impact on the housing market, probably not a lot more to come. We've already seen that priced into mortgage rates. So I suppose now it's about how people react to that. And obviously new borrowers right now are seeing those current rates, good for them. There's still this sort of pass through to go for existing borrowers. So, they've fixed 2 or 3 years ago, whatever it is. And so, still on those slightly higher, older fixed rates, still to reprice down to the new current rates. So there's a bit of pass through still to come. If you look across the stock of fixed mortgages, the average rate currently being paid is still 5.9%. So, there's a lot of people still to roll through to that 5% mark or even slightly below. So I think it's probably more about, in terms of housing market impacts, economic impacts, it's probably more about all those people, existing borrowers who are yet to fully reprice. So that's still an impact to come through. But of course, people might save that cash. They might look to rebuild their buffers. They might also keep their repayments the same on their mortgage and reduce the term. So it's not necessarily the case that all that cash will suddenly sort of flow out into the economy or housing market, but there is still a lagged impact to come. So probably more about market interest rates rather than the cash rate.
How should investors be thinking about their debt given that inflation is under control at the moment?
I guess, we've seen historically, if you go back 20, 30 years, everyone talks about, well, interest rates are very, very high. So that was bad. But at least with high inflation, the real value of my debt was eroded very, very quickly. So the debt felt small quite quickly, even if I was paying high interest rates. So, but that's in the past, of course. Now we're in a new environment where inflation is lower. And yes, over the past couple of years, it has been higher than it normally is. We got up to 6 or 7%, but it's come back down. And right now we are in that 1 to 3% target band. So, yeah, I guess in a low inflation environment, that real value of your debt is not going to be eroded as quickly. So I suppose it's about just how you manage that with the interest rate side of things. And I suppose on the flip side at the moment, with inflation lower, it also means that wage growth has been a bit lower as well. We're not seeing that flow through as quickly. So there's lots of moving parts in there. I suppose as always, it's at a household level. Really, you just got to operate in the environment you're in, and I'm not necessarily sure people would perhaps think about inflation directly in terms of how they manage their mortgages, but certainly they have to think about inflation in terms of how they're managing their household budgets in terms of food and power and all of that sort of thing. And then related to that is the indirect impacts of mortgage rates and how they react in that environment with their mortgages on that front. And I think what we're seeing at the moment now is that the people are perhaps just starting to fix a little bit longer, whether that's due to some concerns about possible inflation coming through, who would know, possibly about uncertainty in the global economy, possibly just some good interest rates on offer from the banks. So, for a while there, people were floating or fixing short, but just starting to see in the Reserve Bank data now that there's a sense that people are just starting to fix a bit longer again. So, sticking short for a little bit of their debt, but also fixing longer and locking in a bit of certainty. So, yeah, I'd say it's probably more about interest rates, about how people are managing their mortgages. The inflation side of things is obviously related to interest rates, but that inflation and general cost of living, I suppose, is more in relation to, I guess, just your day-to-day sort of spending.
And what are the smart investors glued to in terms of the macro side of things? Is it unemployment, GDP, migration? What are the smartest investors look at?
Well, don't know, because I don't know who the smartest investors are. I guess what I think in terms of the biggest impacts on the housing market right now, the sort of conflicting forces. So I suppose what people now, as I say, I don't know who the smartest investors are. That's a subjective thing. But in terms of I think the two big influences that the people should be watching, or certainly what I'm watching, is obviously on one hand lower interest rates. So that's flowing through to that is going to be supporting the housing market to an extent in terms of driving sales, driving values. But on the other hand, and I think you can probably look at the impact of lower mortgage rates so far has probably been relatively muted. As I say, we've only really just had sales return to normal now, and property values are still a bit patchy. So maybe in previous cycles we would have seen a bigger impact from lower interest rates. This time, it's kind of there, but I think on this occasion, the other side of the ledger is the weak labour market and weak economy. So yes, people are benefiting from lower mortgage rates, but at the same time, if their businesses aren't going so well, if their job security isn't as high as it was, they're not necessarily going to rush out and commit to a new property purchase. So, lower interest rates are there. That's having an impact, but it's just at the moment, I guess, being restrained by their weak economy and their weak labour market, and probably confidence levels being a bit subdued as well. So, I think that's the factors that are sort of working their influence on the property market at the moment. But yeah, we are seeing. Whether they're the smartest or non-smart, whatever, what we are seeing is that, and property investors are coming back. So people are actually voting with their feet, and time will tell if it's a good decision or not. But what we are seeing right now is that property investors are coming back. So our data is showing that mortgaged investors' share of property transactions is rising. So after a couple of years where it has been pretty quiet, we are seeing property investors come back to the market, and tax changes have helped. interest deductibility, shorter bright line test, reduced LVR rules, all those things have helped. But really, for me, the big factor for people coming back to the property investment market is surely lower mortgage rates. Your top ups will be smaller. Go back a couple of years, those cash flow top ups each week might have been $400 or $500, depending on what property you bought. Now, a new investor might be looking at $200 a week. So it's still significant, but a lot less than it was. So, yep, smaller tax bills help. All of those other things help. But really, when it comes down to it, that hard cash flow, that's the thing. And the biggest difference there has come through lower mortgage rates. So yeah, people are, voting with their feet in some ways. Yes, there's those different factors. The economy is still a restraint, but lower mortgage rates are helping, and people are seeing those top ups fall and coming back to the investment market.
We're still 16% below the peak based on this report, how I'm reading it. What does the historical data show about how these recovery phases tend to unfold in New Zealand?
Well, we don't have a lot of data on this because there hasn't actually been many downturns in the first place to flow through to a recovery. We're only really, obviously the biggest one in recent history was after the GFC. What happened there is that property values fell about 10% from peak to trough. They peaked in 2007 and fell about 10% over the next couple of years, and then got back to that previous peak in about 2012. So it was a 10% peak to trough fall. Took sort of 2.5 years, and then 2.5 years to get back to that previous peak in 2012. So, at the time, that felt like a pretty big downturn. What we're seeing right now is that, as you say, property values are still down 15 to 16% from that peak. This is, pushing sort of 2.5, 3 years later. What are we? Yeah, we're almost 3 years later on from that previous peak, and we're still down 15 to 16%. So. This one's been deeper. It's already, probably past we'd already seen the trough at this point in the GFC cycle. We went into that recovery phase. This time's proving a bit slower to get going. And I think there's a chance that it does take quite a bit longer to get back to that previous peak in this cycle because, as I say, right now we've still got a pretty soft economy. There's a lot of listings out there. Affordability is still a bit of a challenge, but we've got debt to income ratio restrictions this time too, and LVRs, which we didn't have post GFC. And I think the DTIs are not really doing anything right now in terms of individual borrowers, although starting to hear anecdotally that some borrowers are just starting to feel a few more impacts from those DTI rules. But it does, over the medium term, probably slow down the rate of house price growth, slows down the rate at which investors can expand their portfolios. So it's going to become a bigger consideration. So, it's sort of crystal ball gazing, but it wouldn't surprise me if it was, 2028, 29, 30 until we got back to that previous peak. So this cycle could be 8 or 9 years rather than that 5 or 6 we had after the GFC. So it's been pretty deep, it's been pretty slow, but of course we had a big boom prior to that. So when you see house prices during COVID go up 40% in 18 months, there's going to be some payback at some point, and I guess we're just in that phase now.
Well, I appreciate your insights today, Calvin. Where should people go if they want to read your Cotality report?
Well, unfortunately, our website is still www.corelogic.co.nz, but that's about to switch in the next week or two. So either Google CoreLogic or Cotality, and you'll find all of our stuff there. And in a couple of weeks' time, it should be all Cotality. So hopefully everyone can navigate to that.
Appreciate your insights, Calvin. Look forward to chatting again soon. Just a reminder, your competition has already hit subscribe on the fastest growing property and investment channel in New Zealand. They're getting the tips, the tricks, and the juicy insights before you've even finished your coffee. They're buying, building, and banking profits while you're still sitting there thinking, should I click a button? Come on, be clever, hit subscribe, or don't, and enjoy watching everyone else get rich.